And as usual, any questions that you might have as we go through the live session, please feel free to ask them as we go along on this journey to the NFP. So to get started, let's just take a look at what we're looking at in the next the next hour with my special guest Daniel, who will join me shortly. So we've had the US confirmed recession. It's reading two negative GDP data for two consecutive quarters. We've had the rate hikes as well, and also the NFP is looking likely that it will be a detrimental one for the jobs market as well. So let's just take a look at what we're seeing in the near term. As I said, any questions you want to direct at me or Daniel as we go along, please feel free to do so. So let's just take a quick look at the disclaimer before we get started. So foreign exchange trading in investments and derivatives, CFDs, can be highly speculative and may result in losses as well as profits. Foreign exchange and derivatives may not be suitable for all members of the public, and risk capital should be applied. This webinar is provided for information purposes only, and obviously it's our own information purposes. So be aware that if you are trading this NFP, do your own due diligence. We are here to help as well. Obviously, Orbex Limited does not guarantee the accuracy or completeness of any information or analyst supplies. Without further ado, let's just take a look at what we're looking at in the near term as well. So we've not only got the American job numbers as well, we've got the Canadian job numbers. So the dollar CAD, or the LEI as it is also known, can be very, very well traded upon as well in this circumstances. So let's just take a look. Analysts are looking at a slight decrease to 250,000 jobs, up over 350,000 in the last reading. So quite a big job number loss expected. So will we get that job number loss, or will we see another upturn in the market? So as you can see here, 372,000 versus 250,000. However, the unemployment rate is saying at 3.6%. So that's supposed to be quite a good figure. It means that the employment on a weekly basis is steady. However, we are still looking back to see if the total number of employed persons in the US is yet to reach pre-pandemic levels, which is a little bit worrying as well. So let's just take a look at the figures here. So had quite a big jobs market over the holiday season in the US, which was kind of natural because obviously there's more jobs to be filled in this particular season because there's more supply and demand. However, as the year started to unfold, obviously we saw backtracking numbers in the NFP, and that's given us a reason to worry slightly to see where the next course of action is from not only the US jobs market, but the Fed as well. The Federal Reserve really kept on aggressively raising rates. So that's going to be something to, let's say, worry about. Let me know what you think about the US jobs market. How is this kind of decline and then move to the upside, and then another vast decline? These numbers here were the worst that we've seen since the pandemic started. Obviously, we got into negative territory at one point, but since we've got into positive territory, these numbers are still very low for a monthly jobs market addition. Obviously, during the height of the pandemic, we had the lockdowns coming. Well, the lockdowns ending, so a lot more jobs were on offer, a lot more people getting back into work, especially after the US government stopped handing out paychecks for those people that were on COVID schemes. As I said, though, this big push in the jobs market So I've just got a couple of connection issues. Just bear with us at the moment. And it seems we are back on. Sorry about that. So let me just share my screen again. And just had to refresh there for a second. And it seems that we are back on now. So thank you for sticking with us. Few connection issues. As you can see here, we are looking at the weekly jobless claims as well. This is starting to creep up a bit slightly. This is on a week by week basis. This has started to creep up. It was hovering roughly about 200,000 for quite a long time, but we are now moving up above 250,000. So could be a cause for concern in the near term as well. We'll have more on that when Daniel comes on shortly. But annual inflation, we have to talk about this. It's a very, very detrimental subject at the moment. It's happening across the globe as well. We had the Bank of England yesterday raising rates because we had, because of the high inflation. The Fed is raising rates aggressively. We are now looking to see what's going to happen in the near term as well. And we are looking at also another move to the downside for a lot of the dollar pairs as well. We'll check the charts out shortly, but let me know what you think as well in the near term, because the inflation seems to be creeping ever higher and it's not really looking to slow down anytime soon. So in that respect, we'll see if the Bank of England, the European Central Bank, starts being quite aggressive as well. So retail sales as well, they jumped back into positive territory. They were actually in negative territory, the last reading around at minus 0.1, up to 1% now. And this gives a little bit of a slight satisfaction to the US labor market, because obviously more people have, well, a few more people have a bit more disposable income. But with all these rate hikes that are happening, will there be disposable income for a lot of Americans in the near term, especially as we head into the back end of 2022? Don't forget, we're in the third quarter now, and it's looking quite positive in the run up to obviously Thanksgiving, Christmas, these kind of holidays that a lot of Americans do start spending money on. ADP, we didn't have a reading last time around, so I've kept it on the last reading, which was at 128,000 jobs. It did miss expectations, well below 300,000, and it is actually possibly the next time around we're going to see another move to the upside. Just been asked from Nikhil about gold. Well, I've just got on the chart here. I've just gone on the daily chart at the moment. We're going to look into this a little bit more in detail, but the daily chart, I've just signaled the 1800 handle, because the fact is we are creeping up steadily to that figure. If you look, this is only a few sessions ago when we were at the 1700 handle just over a week ago, and now we've climbed nearly $100 worth in, $100 worth back up to the 1800 handle. So it's quite significant that this move is probably going to be likely. We're having this full V-shaped recovery since we crashed down. This was only on the beginning of July. So within a month, we've had a full recovery back to the 1800 handle. And a lot of analysts are thinking that we will, if we do crack the 1800, then we could even possibly start moving to the mid 18, possibly by the middle of the month. It's not out of the question that we will start seeing this particular move to the upside as well. So gold at the moment, as I said, just on the daily chart, because we're just seeing the significance of the Ukrainian-Russia conflict. Obviously, the Fed hiking more rates aggressively in 2022, and now we're seeing this full V-shaped recovery. A lot of traders are turning more to the safe haven asset, turning more to gold to try and see where they can get their bids, where they can get their funds, and obviously they're going to probably start cashing in on gold. So there could be a sell-off shortly. With every push in the market, we do see a slight correction, possibly a little bit lower, but then the indication at the moment is that we are now possibly going to start moving to the upside and seeing this move into gold as well. So let's see what happens in the near term. So I hope that answers just gold for a few minutes while we just get back onto the presentation quickly. Nearly finished though, because I just want to show you, tell you a few tips on how to protect your risk capital if you are trading big fundamental news events like the NFP. So basically, if you are not experienced and you don't like trading high impact fundamental news events, then avoid the NFP altogether. This is very, very significant, because if you're not comfortable with high volatility, if you're not comfortable with price action going higher and lower in a few minutes, then don't trade it at all. This is a very good tip to get out of the market altogether. Apply protective stop loss and take profit risk management measures to bypass these emotional hurdles. So like I always say, we've been there, we've done that. Opening and closing trades because of emotions. Try and keep them out of your trading profile, your trading strategy, to make sure you're maximizing the whole effect of what you're trading as well. Point number 3 touches on point number 1, close out all positions, if any, ahead of the release to move away from high volatility. So let's just quickly, just wanted to give you a quick example of that. So the pound dollar pair, we saw the Bank of England raise its rates to its highest in quite a long time. And at the time of the news event, just going on the minute chart now because I want to show you the big push in the market yesterday. So as you can see here, this was when the news was released, and within 1 minute, or within, let's say, 5 minutes, we've gone from 122.14 right down to 120.90. So let's just say 121. So nearly a 200 pip move in just over a couple of minutes. So these are the things that we want to avoid when we are trading big news events. So just because you put in let's say you've put in a buy position roughly about here, or a sell position, let's say you put a sell position and you've put a stop loss up here, so you don't want to lose any further funds than here. However, if there's gaps in the market, say from this particular, I'll just zoom in so it's a bit easier, from this particular mark here up to here, then your stop loss won't actually be in effect. It would be actually cancelled because there's no price in the market here, because the market's moving too quickly, and it is the whipsaw effect has cancelled out your stop loss as well. So these are the things that you need to avoid if you're trading high fundamental impact news events. So the market opened here, let's say your stop loss is here, but the next available price is up here at 122.12. So your 121.98 stop loss was not hit because there's no price in the market. So unfortunately, because of the big whipsaw effect in the market, the big volatility, it means that your stop loss was not taken, and your trade is still open because your stop loss price just wasn't there. And then that leaves you open and exposed to making losses. So just be careful if this does happen. As I said, though, this is just an example. Bank of England declared its interest rate decision at 2 o'clock yesterday, GMT plus 3 times. So it'll be 11 o'clock GMT. And you saw these big moves in the market. So this is 1 minute. This is almost 50 pips in 1 minute. And the next minute came nearly 30 pips. And you get the general idea. So within 5 minutes, we've moved over 125 pips. So quite a big move in the market. And in doing so, it has left a lot of trades exposed and open to this whipsaw effect. So this is just touching on what we don't want to look at the moment. So hedge your positions, if any, ahead of the release. Hedging is a good strategy if you've got positions open and you're fully hedged. However, it doesn't mean that you won't get stopped out on some prices because of the big moves in the market. Just been asked about the euro dollar as well. Let's go back to the charts then quickly. As I said, any live questions, please feel free to engage. No problem at all. So the euro dollar at the moment, it's been a bit flat today. As you can see, it hasn't really moved out of its range. We are looking for a little bit of a slow dollar, a weak dollar, let's say, if the numbers come in and it's under 250,000 jobs being added. So it could be a weak dollar at that particular moment. So we'll just put this back on the tile windows. So to answer your question, sir, we're just looking to see what the next move is for the dollar, because if it is, we've got 375,000 jobs from last time around, 250,000 possible for this time. So it's quite a big miss off of that jobs number, and it could be a very, very weak dollar as well. So Daniel is just joining me now. So that means I just have to put on my magical headset, and we'll just add him in right now. Hi, Daniel. Welcome to the...
Hey, David. So how's the technicals going?
Yeah, technicals are going all good. Just add you to the big screen. So thanks for joining me today. How are you doing?
Good. A little bit sleepy, but, getting used to it.
That's
How
good
are
then.
things
Well,
over there?
yeah, not too bad. Hopefully the NFP will wake you up a little bit then.
Yeah, there might be some extra moves going on.
Exactly. So, Daniel, just telling our viewers about the double whammy, let's say, from the last time around for the American jobs market. We've had not only the rate hike at the end of January, but we've had a confirmed recession, 2 negative readings for GDP in America as well. Plus, actually, a triple whammy if you think about it, because we're expecting 250,000 jobs only to be added, as opposed to over 350,000 in the last reading. So, where would you say not only the American jobs market is going, but the Fed is going as well on next time around?
Oh yeah, it seems to be that the markets initially after the meeting kind of got the idea that because the Fed started talking about becoming more data dependent instead of doing a more longer term projection, it gave a lot of people the idea that the Fed might be about to stop hiking. And so over the last 2 weeks ish, the Fed has been able to come out. Several members have come out to say that no, actually, we're hiking to get the market a little bit back in line in expecting the rates to go up. So of course that would naturally have a little bit of a negative impact on the stock market and such. So probably, I guess the Fed, at least they're trying to tell everyone that 75 basis points is on the table for the next meeting. Even Daly, who's a significant dove, he even hinted that potentially up to 100 basis points, but maybe he's just saying that to sort of do a little bit of an overcorrection.
Yeah. Yeah, sure. I was going to say, because we had the negative data, well, the American British data yesterday, when the Bank of England did decide that it's going to raise by 50 basis points, one of its
Right.
highest hikes in many years. And just to bring you onto what we were checking earlier, just before you came on, we're looking at the pound dollar chart, because when the news was made, it seems like it was very detrimental for the pound. It did slip over 125 pips in a matter of a few minutes. And since then, it has actually kept on progressively. It's kind of tried to do this recovery, but it's kept on moving down during the near term as well. So, I mean, these rate hikes for currencies especially, I guess they're not so progressive, then not such a good news read for a lot of traders.
Yeah, they're kind of, there's a lot of moving parts. And so you can sort of think, oh, they've hiked rates more than they did last time. So that must be a more hawkish tone. But then in the press release, they will go and talk about, in the case of the BOE at the time, they'll talk about how there's a potential recession coming in, and that inflation is going to keep going up until I think they're going to up to 13%. And so, yes, they're raising rates, but the message that they're saying is also there's a lot of problems coming, and so naturally this would push the pound a little bit further down, even though everyone was just sort of expecting, even though normally, of course, a rate hike would usually mean that the currency would get stronger because the interest rates would go up. But if the
Naturally.
interest rates aren't keeping up with the inflation, then actually the real value, the real rate of return that you have on investing in that currency is actually going down. So you have to balance a whole bunch of different things when you get these releases coming out. So as you mentioned, it's always a little extra risky.
Exactly. And just to keep on that subject, Daniel, we've had the IMF saying that Europe is headed for a recession by the end of the year. The Bank of England governor did say we have to raise rates, otherwise there is a certain recession. But I think the recession is pretty much upon us, isn't it? I don't think there's any way to get by
Yeah,
it, especially in the European sector.
there's kind of a bit of a debate on what actually constitutes a
Yeah, in this post-pandemic age, yeah.
yeah, everyone likes to have the words fit what their particular view is, and not necessarily what's actually happening on the ground. But the good thing for us traders, of course, is that the market is going to react to the data, and it really doesn't matter whether you technically meet a definition or not. So, if for all practical purposes, the markets are behaving, the central banks are behaving in either in a recession or the prelude to a recession. So whether you want to use that specific definition or not, you still have to have, like, your trading should reflect reality more than whether you agree with the definition.
Yeah, I was just going to say, it's an important note for our traders to kind of like focus on what the numbers are rather than what they could be, and what the reality is rather
Yeah,
than the hearsay.
Yeah, well, there is a bit of a thing about the jobs numbers that I wanted to mention. There's a bit of a tangent, I guess, but the thing is, one of the arguments that they say that there's no the recession in the United States in particular isn't really going on is because you have all this jobs creation. Well, I mean,
Yeah.
this number that's expected isn't all that good, but the last few have been pretty good, as I mentioned, you were mentioning previously. So the thing is, normally in the case of a recession is either coming, or if we're already in a recession, you're going to have the jobs numbers are going to go down, and you're going to even have negative job creation. But the thing is, right before you have a recession, usually there's much more balance in the job market, where you have more or less the same number of job openings as you have people looking for work. So if the number of job creation, or if companies are or employers are sort of thinking, you know what, the economic situation isn't so good, I'm not going to be hiring as many people right now, I'm going to wait until the
Sure.
situation improves, then the number of open jobs goes down. And then if the open number, the job, that number goes down, and there's a higher number of people looking for work, then you have a disconnect, and the unemployment rate goes up, and you can have a negative job, or significantly lower job creation, or even negative job creation. But right now we have a bit of a distortion because according to BLS, the latest survey, which we get from June, because there's a month delay, we can't get the July just yet.
Right.
There were, I think it was 10, it was over 10 million, 10.5 million, if I, or 10.6, one of those two numbers. Doesn't make all that much difference.
Yeah.
Jobs that were open, and there were only 5.9 million people looking for work. So what can be happening is that companies can be deciding to not hire as many people and reducing the number of open jobs. But because of these two numbers are so far apart, people coming into the market looking for work might be able to still be able to find it, even though the number of job offers are going down. Because part of this is the labor force participation rate might be one of the keys here, because the labor force is going, the participation rate is significantly lower now than it was before the recession. In fact, well, yeah, before the pandemic. So in fact, it's quite similar to what happened back in the early 80s, back when also there was a high level of inflation. So there's a couple of parallels there, and there might be, again, more details to than just what the headline number is saying.
Yeah, as I said, there's got to be a lot more tangible things to put into where the jobs market is going into.
Yeah, so even
We
you could have like a high jobs number, and
yeah,
but this is kind of like one of the odd things that's been happening, because you keep getting these 300 something thousand jobs created, but the
yeah,
unemployment rate stays stuck at 3.6%. So
yeah. I was going to
if
say
there were, yeah,
it's rumored to be 3.6% for the next time around. So, and the same
yeah,
in Canada
exactly.
as well, similar figures. So, yeah, like you said, there is it is a bit distorted with the actual figure and what's actually going on in the labour market.
Yeah, that might be something to sort of take into consideration, because even if we get a significant beat, the market might respond to that sort of immediately. You might get, increased optimism, and then it might fade, say later in the session, particularly going into the weekend, or maybe tomorrow. You might get, say, if the other also is right now people are betting on the Fed. So if you get a
Yeah.
good uh, jobs number, then you would also get a bump in the stock market. But right now, the stock market is waiting for the Fed to stop raising rates, and so you get a good jobs number, then the stock market might go further down, and the dollar could get stronger, which is kind of like, again, the inverse of what you expect, because it's kind of an unusual situation.
It is, yeah, yeah. I mean, I want to touch upon gold and oil, possibly
Oh,
after
right, yeah.
but we'll do it probably after the results because only 5 minutes to go. I just wanted to quickly go on the euro dollar chart. I'll just share the screen again because we had a few questions on where the euro dollar looks like it might be going, and if I just put it on a daily chart, we've seen this vast progression since on the dollar since we saw this swing high at the end of May, and
Hmm.
since then we had parity in the pair. We've had a little bit of a bounce back since we hit that one-to-one level, but it hasn't really given a lot of traders comfort, especially the bulls, that the euro dollar is going to get back to where it was anytime soon. It is still progressively weighed down. So does this mean that it's a stronger dollar all round, or does it mean that Europe is just a bit weak as well, because obviously they've got this recession they might have to fight off. They're not going to have oil supply from Russia by the end of the year as well. All these things going into play. Does this mean that we could see the euro dollar weigh down a bit more for the time being?
Yeah, it's probably a bit of both, really, because if the if the euro area is about to get into a recession, then we could expect that the ECB isn't going to be able to raise rates all that much, and they've been really
Mm-hmm.
slow to the table to start raising rates. They've only brought rates back to zero, while
Mm-hmm.
the Fed has been going significantly higher than that. So you have a really big spread between the two, and so of course
Yeah.
that's going to be pushing the euro down. And the other thing is that the inflation rate in the eurozone keeps going up. It's
Yeah.
a little bit less than the United States, but it's really the further both of them go up, the less the actual difference matters between the two of them,
Mm-hmm.
and so they're getting pretty close to being at the same, with the ECB having significantly lower interest rates.
Yeah.
And if there is a recession, the presumption is that you would have lower inflation. But if inflation is being driven by sort of non-economic issues, like the war in Ukraine and the lack of the supply chain problems and food costs, then the recession might not actually drive prices down, and you might still have a case of negative economic growth and high inflation, which is not particularly all that common, but it
No.
can happen.
It can, yeah, but yeah, and as you just touched upon there, we'll go into a bit more detail after the results are given. But with oil and gold really moving the markets quite significantly, we're seeing possibly a lot more oil supply or demand from America and Canada towards Europe if they cut off ties from Russia completely, because the Saudi Arabia and the UAE countries just simply can't possibly handle with all the demand that Europe might need,
Yeah,
especially the winter
mostly.
months.
Yeah, mostly OPEC is pretty much all tapped out. Only the UAE and Saudi Arabia can increase production. The Saudis say that they have enough to cover, but I mean that would, like, in an extreme situation, no one really knows for sure how much capacity they have. But given recent events, they estimate about 13 million barrels per a million barrels per day, and they're doing
Yeah,
about 9 now. So they could put in 4, which, and Russia produces 4. So technically they could bridge the gap, but it's like that's
yeah,
assuming nothing goes wrong. You don't have a hurricane going through the Gulf Coast. You don't have
exactly.
anything Libya, that's a relatively unstable. You don't anything can happen.
True.
They can have a pipeline break in Nigeria. So it's
Yeah.
something to. I mean, it's reassuring, but not
A
so
lot of
much.
variables. Exactly, exactly. So just before we go into it, just want to give a brief overview of where the pairs could actually end up at the moment. So, euro dollar, it has been a bit flat today. So we could possibly see a limitation of the recent double tops that we've seen, roughly about the mid 102 range. We've had cable, which was quite volatile in yesterday's session because of the Bank of England interest rate decision. But that is looking to see if we're going to have another move to the upside, roughly, be it limited probably to about 121.68, 121.70. And also we're looking at the Dow quite significantly. Got this on the daily chart because we just want to see if there is some positivity in the job numbers. Will we crack this 33,000 level once again? Well, the results are just about to come in. So I'll just put it onto the tile windows again, and we'll see what is on for the numbers here. So just coming in now. So unemployment rate falls to 3.5%. Okay, so we've added
Ooh,
528,000 new jobs. Wow.
wow,
So
that's already out.
that's a very positive job number for the dollar. So the dollar pairs are really looking very, very bullish at the moment. Very progressive, as you can see. So let's get cable and euro dollar onto the big screen at the moment, see where they are going. So yeah, there always was this, let's say, risk for people that were depending on the news, that it could always go back into a different direction. So 250,000 was expected. So we've got over double that. And as you can
Yep.
see, that's why we are seeing a progressive jump on the euro dollar and the pound dollar as well. And if we just take a look at how many pips that is, it's so far over 50 pips move in just a matter of a few seconds. So we just had a question that we're looking at, wanting to look a bit more at oil and gold, which we shall do shortly. Let's just see a look at the gold movements. The gold is declining as well. So basically, we've had a big jump on the US index as well. Just put that into context as well. Massive jump on the US index. And that's trying to pretty much get back to the recent 20-year highs above $107 that we saw recently. So at the moment, you could say all round quite positive for the US economy at the moment, especially on the forex pairs, especially.
Yeah, it's pretty much confirming that the Fed has plenty of room to keep raising rates, and so they're most likely going to go and push either 75 or 100 at the next meeting, and so probably going to get stronger dollar. I would imagine the Dow took a dip lower somewhere in there. If you have,
yes, it's on a daily chart. Let me put it on a 3-minute. Yeah, that took a bit of a dip. So you would think that's because there is probably going to be now a definite rate hike. They probably will still be aggressive in that policy, most probably in the next meeting. I think it's in September, if I'm not mistaken.
Yeah, the next one's September. There's going to be a lot of attention first on Jackson Hole at the end of this month, 28th-ish, somewhere around there, at the end of this month, because that's when they're going to get together. And if there was going to be a change in the overall policy, they would probably do it at Jackson Hole. But the current data is kind of like saying, yeah, actually, Jackson Hole isn't going to be all that much of an event, and they're going to keep going with the current trajectory.
Yeah. Exactly. You have to think about that as well. So, just want to take you on gold then, Daniel. So,
gold should have been down too.
It has fallen down, but I mean, if my analysis is kind of correct, I was thinking that we were looking at a V-shaped recovery back to 800, 1800. We were expected a slight correction, which I pointed out here. This could be the correction, and then a possible another bounce to the upside. This is only because obviously news could be a bit of a flash in the pan, so to speak. We get this big fundamental news. We see 30 minutes, 1 hour of backtracking, let's say. But could you see gold start pushing higher than 1800 before the month is out?
There's a really good reason for that to happen, is because one of the reasons that the dollar is getting stronger is mostly because it means that the Fed can keep hiking rates, and the Fed is doing that because there's high inflation. So the numbers are basically reaffirming high inflation, which means being in gold is generally a good idea. So you could have like a little bit of a downturn, as you mentioned there, because of dollar. Just generally, that's based on the dollar only, and then the interest back to gold can come into and swing back, and then you could get it moving higher. The only thing would be is if the dollar keeps tracking higher for an extended period of time. That would require another risk thing, and I don't think there's any major date. Next Wednesday they have CPI data coming out, so you could have a little bit of a correction until you get the inflation data, and inflation comes out above expectations, or it just increases, because the current thing is that inflation is expected to come down a little bit. Then you could also see gold push a little bit higher.
Yeah, definitely. I mean, and oil as well. We are looking at oil progressively trying to maintain its $100 a barrel line, but there should be more demand at least for oil in the next as we get back into the back end of 2022 at least. But
that seems to be the theory.
Yeah, exactly. It will be interesting to see how the Russia-Ukrainian conflict pans out as well.
Yeah, and also with the getting through, starting in September in Europe, they start needing more fuel for heating and such. And so, and also you get the switch in the United States, where now they're using a lot of fuel for air conditioning, and then that's going to switch in September. So now they're going to need heating oil. And so for air conditioning, you use more electricity, and electricity is a lot easier to supplement with natural gas. But for heating oil, you do need the crude. So then you'll have probably more demand for crude later in the year as well.
Yeah, that's true as well. I would expect as well. So just to recap, we've got a lot of the dollar pairs still progressively holding their own. Usually we get quite a big, a whipsaw effect, and we do get a recovery.
There will be a little retracement usually. But
but it seems that they are actually holding their own for now, still progressively, especially for the euro dollar, still holding that 50 pip move in the favor of the dollar. So if we just take a look on the euro dollar, because we're getting a few questions about it as well. In that respect, Daniel, I mean, could this be just a slight correction before we see another move to the upside? I put it back on the daily chart so we can see the whole picture from this progression. But if we look on the daily chart, this move, it has pretty much been quite similar
in the line, yeah.
yeah, it's still kind of in a range at the moment. So nothing too much for our traders to sink their teeth into at the moment. It'll be more of a case of, are we going to start seeing parity levels in the next few sessions? Because it did kind of bounce off parity quite quickly, didn't it? We saw it for just maybe a session or two where it just dipped below, but since then we had firm support and then a move back up. So could you say that unless we start seeing parity levels and maybe a break, not to get too excited that the euro dollar is going to start crashing anytime soon?
Probably not. I mean, the thing is, we're going through August right now when there isn't all that much action with central banks, and it's pretty much all being driven by central banks at the moment. So you might have just trending sideways until we get some stronger direction from some of them. Again, going back to Jackson Hole, and of course the CPI data that's coming out. I forget when the eurozone also has their inflation rate. I don't think it's next week. It must be the week after. And so if you get a significant switch in those two in terms of direction, then you might have a move. But for now, this is kind of like a lot of the big traders are on vacation. And so you generally kind of get more of a continuation of the current trend, but it's so close to that that psychologically important parity level. There might be still another chance for another bounce off. I would expect more on a technical level that it would bounce off a couple times before, if it goes through, or if it moves back up. But that's a personal expectation.
Yeah, of course. No, it's a good expectation, because this is what I'm feeling as well. I don't think it's going to start moving anytime lower too dramatically, and we are still looking at other factors that could move dollar pairs as well. Obviously,
I was trying to go through the. Sorry.
No, I was going to say the NFP is one. Now that we've seen the ECB starting to raise rates, could you see other central banks around the world get a bit trigger happy and start just raising rates just to be in line and conform with a lot of the big nations?
Yeah, that seems to be the case, though. Pretty much all of them are already on that trajectory. You have Mexico going along with it, and then of course you have Turkey going the opposite direction as usual. The main exception, of course, is Japan. But that's going to really depend on whether they start seeing impact from inflation. But now that you've had this increase in risk aversion, and the yen has gotten a little bit stronger, then maybe Japan is going to stay on the sidelines. The other thing would be, now that the BOE has cracked their 50 basis points, and if the Fed goes on with another 75 basis points, there's going to be a lot of pressure for the BOE to do another 50 basis points, particularly if they're expecting inflation to go up to 13% by the end of the year.
By the end of the year alone, which isn't so far away. If we're in August now, by the time the August period is over, because like you said, a lot of big traders have a bit of a break in August. Once we get back to September, there's only 5 months of the year left. So if you discount December as well, where the market goes a little bit flat, there's only really 4 months of trading and 4 months of volatility that we can see before the end of the year. And it's not really a long time for interest levels, inflation levels to go from 9% up to 13 to 15%. Like you just mentioned. So it could be quite a volatile end to the year, the next few months.
Yeah. Well, speaking of volatility, I was just looking at some of the components to see if there might be a reason for it to go back the other way around. And if we look into a little bit of detail for wrong thing I clicked on, non-farm payrolls, the birth death adjustment was 309,000. So that means it wasn't 309,000 jobs added. It's that they adjusted the number to account for the number of people who potentially had left the market, because because they passed away, and so that might provide some conditionality to the move. So you get that might lead to a little bit of fading as traders process that a little bit. And then where's the other one is whether the prior one. Oh, right. Also, the prior one was adjusted higher. So that's another reason for it to keep going. So now you got two conflicting little bits of data there. Prior change in non-farm payrolls was higher, 398,000. Yeah.
Wow. Okay then. So
there's more volatility coming probably.
Okay. And Daniel, as we come to the end of the presentation, I was leaving this for the last moment because I wanted to have a quick look on Bitcoin as well.
Ooh, right.
we've got quite a lot of traders on a weekly basis asking about Bitcoin. Where can it go?
Mm-hmm.
What can it do? Well, if I just put on a daily chart here, it was ranging between 19,000 to kind of 22,000 approximately. We're seeing a tip above 23,000 at the moment. And, we're just wondering, could it, now that we've found a little bit of a bottom, let's say roughly about the mid to high $18,000 range, is this the bottom that a lot of traders have been waiting for? And are we going to see it progress and possibly get back to, well, not to record levels, but possibly $30,000, $40,000?
It might be. I'm always looking for that, because I don't know whether we should be looking at about 18 to 20,000, or should we be looking at 10 to 9,000. But
Right.
given the dynamics that we had in the pandemic area, where the Bitcoin cryptos in general were pushed much higher because of what the Fed did in terms
Mm-hmm.
of easing rates. Also, the dynamic of crypto is also going down, mostly because of how the Fed is behaving. So, really, whether or not we've hit the bottom probably will depend on whether or not the Fed starts easing, and then there's more funds available for people to start invest to Bitcoin,
Right.
because
Okay.
it's kind of a higher risk thing. And so right now, over the last 3 weeks, so there's been a bit of a move higher in risk appetite,
Mm-hmm.
and also we've seen a return of the meme stocks as well. So retail traders are coming back into the market, potentially looking for a
Right.
bottom, so that could push markets up a little bit higher. But generally, during the summer, we have a bit of extra optimism. There's a little bit of a surge, but then comes early September, that often
Yeah.
turns around. So I would feel a little more comfortable that saying that we'd reached the bottom if we're talking about this sometime in early September,
Mm-hmm.
than right now, because right now this sort of extraneous factors that could be pushing it up a little bit higher. And then, if after the Fed's rate decision in September, whether they start pulling on their tightening, that might free up some extra cash for people to start investing in a little bit more risky assets. And so that might mean September going forward, but it might be a little bit early.
Yeah, true. Okay, Daniel, and I've just been asked a question about euro dollar again, the
Oh,
direction in the
okay.
next week or so. So, I mean, if we bring it back to the daily chart, what we spoke about earlier, because we just went into this as well, was we are expecting a possible resistance roughly about where these spikes are here. Just because we did get a bit of a detrimental downturn today for the euro dollar, it doesn't mean that we are going to see this continue. So the likelihood for the euro dollar is that it will keep ranging until we see a possible breakout, possibly above the 102, the mid 102 range, I would have thought, because we've seen these little spikes on the daily chart here trying to push higher, but it seems it's getting a lot of resistance at these kind of levels. So I believe that if we do get a breakout, we can start seeing progression towards the 105 handle, possibly towards the 110 handle, and recover this dramatic move to the downside. But like we were just talking about, parity is possibly a little bit of a long way away, and a break of parity could be even more detrimental. So just had that one last question from one of our traders.
Well, if they're really looking for potentially when you could get a move higher with the
Mm-hmm.
euro, like probably Wednesday, with the data that comes out on Wednesday, that might give it the push that it needs to get either above the 102 or
Yeah.
to push it back down to parity. So that, on a fundamental basis, maybe a little bit of patience until Wednesday.
Yeah, Wednesday's a key day. So that's Arthur. Thank you for asking that question. He just wanted to double check on what's happening with the euro dollar. So just quickly, a final note on Bitcoin then. We just wanted to see, basically, we are now treading a little bit higher. And obviously, Bitcoin does move in dramatic fashion most of the time. But in the last few sessions, it has been pretty much of a sideways move since we bounced off the 19 or 18,000, 19,000 handle. So with that being said, would you say the Fed is a little bit more, has more of an influence now on Bitcoin? Because before Bitcoin, 4 or 5 years ago, it was just something that traders would just jump on the bandwagon. But now, would you say the Fed is kind of moving it slightly?
Kind of, but indirectly. I mean, a lot of people who are into crypto sort of
Indirectly,
like,
yeah.
yeah, they bristle at the notion of crypto being influenced by the Fed, but it's a matter of supply and demand, basic, Econ 101. If there's a lot of extra money out there, people are going to want to put it someplace. And the whole point of crypto is that it's supposed to be a good place it's supposed to be an alternative to the vicissitudes of the dollar. So if we're having high inflation and there's a problem with a recession, then people might be more interested in jumping into crypto. But in order for them to do that jump, it will be a lot easier for them if there's more extra cash floating around. And who is it that provides the extra cash? It's the Fed. So to say the Fed is moving it is maybe a little bit of an oversimplification, of course, but the Fed is influencing the general dynamics of the market, and the crypto can't be completely disconnected from the general dynamics of the market. And so since right now we have risk off, we have people need the cash to buy into crypto, and with higher interest rates, it's harder for them to borrow money because most of the people are doing these investments on margin.
That is true.
So,
that is true. Okay, then. All right, great, Daniel. So just a final thought on some of the pairs here. It's still progressively moving. Big move for the dollar in the, it's bigger than what we've had in the past with the other NFPs. We've usually had like a $20, $30 pip move and then a full retracement after 5 minutes. But it seems at the moment we are seeing a 60 to 100 pip move. The pound dollar, the cable pair, progressively moving towards 100 pips, 92, 93 at the moment. Same with the Dow, same with gold and dollar yen, and with the loonie as well. So it all progressively moving in favor of the dollar. So quite a good move for the American market. Very shocking that it added over 500,000 new jobs. Well, that's the figure at the moment.
Yeah, it seems to me what's really getting caught everyone by surprise, because it's double than what was expected. Yes. And the thing is, in order to recover the full amount of jobs that were lost during the recession by the end of this year, you would need to average about 500,000 jobs. So if it's above 500,000, that's kind of like saying we're getting close to full recovery pretty soon.
They're on target, yeah, exactly. Yeah. Okay, then. Well, great, Daniel. We've got no further questions from our audience. So thank you once again for joining me on this NFP merry-go-round.
Thanks for inviting me. It's a bit more exciting one, so it's a good thing I was around.
Exactly, yeah. The bigger the move, the more exciting, more things to talk about, and obviously more opportunities for our traders as well. So this is the main thing. And we can possibly see another move on Wednesday when we get more fundamental news coming out. So for our traders watching, just be careful for the rest of the trading session, because there could be still some whipsaw effects in the market. Full retracements are possible when the market does calm down, and obviously less liquidity is in the market as we go into the weekend. So just be aware of that. So once again, thanks for joining us, and we'll catch you next time. Thank you very much, Daniel.
Take good care of yourself.
Thanks again. Bye for now.
Bye.
Okay, so Daniel's gone. Once again, thanks him for joining me. And any questions that you've got, let me know. We're still going to keep this going for a few more minutes just to see what the progression is for the dollar pairs. So, as we've got a few questions on YouTube and Facebook Live, we are seeing now very big progression in these pairs. So if we're looking at levels in the market, as you can see, we've had this move to the upside in the last couple of trading sessions. And this was almost a 100 pip move. We're going down now for the 100 pip move to the downside, which will probably take. We're probably going to start hitting some support soon, because as you can see here, we are seeing some bounces and some possible false spikes here. Whether or not we get back down towards the 101, the lower 101 handle, will remain to be seen. But keep an eye out for these big moves in the market. Cable as well. As you can see here, we have actually cracked the last particular move, and this was this double bottom. So cable now, if you look on the 4-hour chart, where are we seeing this next move? Well, we did point out before the 120 handle would be quite significant, which is roughly about here. I can just put it in roughly about there. So the 120 handle is something that we are looking at as a possible next target, especially since the Bank of England did start really moving the currency pairs for the pound pairs, that is, as well. Just quick look on the Dow. The Dow has really been hit quite significantly, moving over nearly 300 points to the downside. It was expected if there was a strong jobs market, like Daniel was saying, gold and the Dow is looking to start moving to the downside. It means that the Fed will probably start aggressively, still raising rates quite significantly, aggressively in their next meeting in September. August is probably going to be a little bit of a dead month. It might not be so much of big moves in the market because a lot of traders are obviously going on vacations. It's a quieter month, so be aware of that as well. Final look on gold. Just got another question on gold. Where do we see it running to at the moment? Well, we have dropped in the last 30, 40 minutes. We have dropped just over $18, nearly $20. So it's not too detrimental, especially when you see in the course of a trading day. Just zoom in, it's a little bit easier to see. In the course of a trading day, yesterday, for example, it had a $30 move to the upside. So if we cancel that out, it still means that we are looking on this correction here, like I said earlier, and then a possible move back up to 1800. So corrections are always in the market most of the time when we see big moves in the market, the correction, and then another move higher. So just be careful of that as well. And looking on the dollar index, well, what can we say about the dollar index? It was falling for the majority of the last few days. However, as you can see here, really big move in the market, gap in the market as well. Looks like a bit of a runaway gap, not exhaustive yet. Exhaustive gap would have covered by now. It would have probably covered this gap here. But looking at this runaway gap at the moment, it is still moving progressively higher. So thank you once again for joining me. This video will be put on our YouTube channel. Feel free to like and subscribe and add any comments that you feel that you wanted to let me know about for next time around. Obviously, the NFP is a very big mover in the market, and we will not ignore your requests. Go full into detail about how the NFP can be traded and what are the possibilities and the outcomes as well. So big jobs number for the UK, for the US jobs market. How will that affect global markets as well? Let me know, and we'll speak again next time around. So thank you very much, and bye for now.